Joining me now is Greg Daco, Chief Economist at EY-Parthenon, and Kim Forrest, Chief Investment Officer at Boca Capital Partners. Good afternoon to both of you. Greg, I'll put that very question to you. Soft landing still on the table here?
I think it's very much on the table after this week's data. We have evidence that the economy did relatively well in the second quarter. GDP growth was higher than expected. We have consumers that are still spending, albeit with a little bit more caution. And we have headline inflation, core inflation, and wage growth that are all moving in the right direction. So overall, the pathway to a soft landing is still very much possible. There are, of course, still headwinds in terms of the economy. But I think dreaming about that soft landing is very much something that we can do today.
Yeah, and Kim, it certainly seems like investors are doing that today. Stocks are higher again. We're poised to end the day higher in the week for all the major averages as well. How much more room do we have to run, especially when you start to factor in valuations? Yes, I realize earnings season has been better than expected largely so far, but it's pretty rich here, this market.
Well, I always, because I'm a perma bull at a certain point, that glass is always half empty, or I'm sorry, always half full for me. But I do think that if you go outside of the winners so far this year, there are a lot of companies that are reporting higher than expected earnings and, more importantly, revenue. And most important, they're guiding higher for this year. So looking forward, it looks like the much anticipated recession is not on the table. And I think if you are a very long-term holder of stocks, you're going to be shopping in the unlooked at and unloved market areas of the year. And that is what you should do.
Greg, Chair Powell this week was pretty clear in saying that we've got 8 more weeks with many more data points to come for the Fed to make its decisions on whether to hike again and what that looks like through the rest of the year. Goldilocks data so far, more to come, I get that. But what do you think? Are we done here?
I think we're done in terms of the Fed hiking cycle. This was likely the last rate hike that we saw from the Fed. Of course, it was very hawkish in terms of communication. Fed Chair Powell made sure that he avoided a situation where markets would price in the end of this rate tightening cycle. We still have markets that are still pricing that, but he was sure to indicate that policymakers could still raise rates even in September if the data warranted it. As you noted, we have 2 more CPI reports, 2 more jobs reports that are going to come due before the next September meeting. So there's a lot of data to come through. I would note that we're not necessarily in a Goldilocks economy. We are seeing signs of a slowdown in terms of the overall momentum of private sector demand. But that slowdown is coming along with an environment where inflation is surprising in terms of the disinflationary dynamics being faster than the consensus expected. So it's a nuanced message. There are still headwinds in terms of the economy. We're not out of the woods yet. We should not celebrate for that soft landing yet. But there is high hope that in this environment, the Fed may be done in terms of tightening and may be contemplating policy recalibration with rate cuts sometime at the end of the first quarter in 2024.
Kim, do you think that's being reflected in the bond market right now? I mean, there is that argument circulating that perhaps Treasury yields have peaked here. And if so, again, what does that mean for stocks?
Well, we price our stocks based on, well, I'm not alone in this, looking at the cash flows and then discounting them backwards. If we think this is the peak, which I agree with your guess that I think we're done for now or close enough to done, I think that we can live in this environment. And if the interest rate environment is lower for whatever reason, and you're a long-term holder of stocks, again, that will reprice in your favor where there's upward motion or upward headroom available in the valuation of stocks. Because, again, we use that 10-year as the inflation rate or the rate at which to discount those cash flows. So looking pretty good at this point.